people are now talking about allocation. 5 years back, passive matlab Sensex Nifty, that's it. So now passive can be international, it can be factor-based strategies, it can be commodities, it can be thematics, sector themes, and also fixed income.
The problem is that when you have so many strategies, the role of an advisor becomes more important over there.
If you look at the entire mutual fund industry, you have difficult to find bad fund managers, but it's very easy to find bad investors. So Indian equity has gone down last 3 months, but foreign equities is up, gold is up, silver is up, fixed income is doing well. Indian equities will most probably beat returns of gold and silver or international funds over the long term.
Hello everyone. Today, in the midst of so many new passive investment options which are available, and we have just launched at Cedrus the Cedrus multi-index strategy. Who better person to today call on than Pratik Oswal, who's a dear friend, and in fact 3 years back he was a part of our knowledge series. 3 years back, I think, those were different times.
Yeah.
I think, and I remember you had told one thing, and people will not like it, will not love it, but cannot ignore this space, in fact. And with so many new indices, passive investment options available, and plethora of so many different index funds which are launched, do you feel the time has come where you need to give some meaningful allocation to this strategy?
So I think allocations was always the perspective. I think the industry started out on a very bad note, I would say 5 years back, when everybody was talking about active versus passive. And that still happens, still, I think most people I talk to tend to compare both types of investing styles. And if you look at the US, I think their passive has been happening for the last half a century, since the 1970s. And if you still look at people's portfolios, it's pretty much half passive, half active. Now, I think increasingly, people are now talking about allocation, not about, competition. People are looking at, what, I think I should have 20-25% of my allocation towards passive. And I think that is a much more encouraging, much more healthy mindset. And I think, so that is one good news that is one good conversations that, I think I've been a part of. The second is that the definition of passive has been broadened. I think 5 years back, passive matlab Sensex Nifty, that's it, nothing more than that. And I think all AMCs had those products. I think what we tried to do, and I think now it's happening in a very big way, is we try to broaden the definition of passive. So now passive can be international, it can be factor-based strategies, it can be commodities, it can be, thematics, sector themes, and also fixed income. So passive is now our strategy when we launched passive was building blocks for asset allocation. And I think now people have realized that, passive could be, if you have an idea, you can create a passive strategy out of it. So I do think that people are looking at passive from an allocation perspective. People are looking at passive from a asset allocation or, a broadened perspective, which I think is good for the industry. And I hope this continues.
That is wonderful. Actually, I remember you were your AMC was the first AMC to have a separate passive investment division. In fact, and you're leading it. And last 3 to 4 years, you have seen so many changes which have come in this space. And definitely the traction for passives is increasing actually. Typically in the HNI, ultra HNI space, coming to the returns part of it, because passives can give you a return which is it can't outperform an index, the underlying index, because it's mirroring the index. So does it mean that as our markets mature, it will be very difficult for active fund managers to outperform the indices, and maybe that's one of the reasons why higher allocation could go into passives? Do you feel?
Yeah, I do agree. I think already it has become difficult, and we believe that as markets become more mature, as you said, as there's less information advantage, there are thousands and thousands of people today in the market who whose full-time job is to just find alpha, and they're all competing against each other. And as we move on, as AI comes in, as more and more quant fund managers come in, as more and more people who respond to little events in companies. So I do feel that the markets over the long term have become a lot more efficient than they were 10 years back, and they will become a lot more efficient 10 years from now. So I think yes, the ability for fund managers to use traditional ways of investing may not survive, so they have to adapt. They have to maybe explore other strategies, or they might have to do more work to gather informational, or they have to just work on different or differentiated sort of offerings. So with that perspective, yes, I do think that passive is going to have a major part in people's portfolios. If you look at the US, approximately 55 to 60% of the mutual fund industry is passive, and obviously India is very small, about 17-19%. But I think this allocation is expected to increase to about 25-30% over the next 3 to 4 years time. So we believe that as and when the asset class improves, you will obviously see it in people's portfolios. So I think that has been the big learning. However, we still feel that India as a country is still very inefficient. There are ample of opportunities to create outperformance. So I think we don't believe that active is dead. We just believe that active is harder. There will be always a lot of fund managers who will beat the benchmark. Even the US still happens, but in terms of the proportion of those fund managers, we believe that number will probably go down over time.
Mm-hmm. But Pratik, one more thing is with so many passive funds which are getting launched, and the NSE itself, I think now there are more than 70, 80, I don't know, so many different indices which are there, and a few of them have, the mutual funds have not launched, but they will definitely launch those indices also, those passive funds also, which the NSE has already constructed. So I could see some SME funds also which NSE is come out with. Don't you feel it will be very confusing for the investor that what to pick? In fact, what kind of a passive fund to pick actually?
Yeah.
The problem is that when you have so many strategies, you have factor-based indices, you have indices which are market cap-based, and you have sector-based. Okay, these are broadly the three different types of index funds which we are seeing. The role of an advisor becomes more important over there to choose the right index for the investor, or else it's quite confusing as to what to pick.
Very rightly said, the role of an advisor is very invaluable. It was invaluable, and I think it continues to be invaluable on the product selection piece, but more on the behavioral piece. If you look at the last 20 years, and if you look at the entire mutual fund industry, you have difficult to find bad fund managers. I think you can pick the winners looking at the top 3, but if you look at the losers over the last 15-20 years, it's very hard to find bad fund managers, but it's very easy to find bad investors, because investors keep shipping around. They go from one fund manager to the other. They do big lump sums in bull markets. They do redemptions in bear markets. So fund managers have created very good wealth for Indians. Let's take a case for our own example. MOMC. We've obviously had about a couple of tough years in the last, say, 4 to 5 years, and now we're back in the top leagues. But all of us have made money because we stayed put.
True.
But a lot of our investors have actually not stayed put in our funds, and if you look at the fund returns, they've been phenomenal. Like if you look at the NAV movement in our funds over the last 5-10 years, it's been incredible. Like incredible sort of wealth creation. But unfortunately, a lot of our customers haven't, because they've come and gone out. So I think yes, the mutual fund industry will become a lot more complex from a product perspective. I think we already had complexity. I think when I started talking about passive 5 years back, my first sentence was passive simplifies. I think if you don't know what mid-cap fund to buy, you buy the mid-cap passive fund and you're set. Now the problem is that now you have 3 different types of mid-cap funds. You have mid-cap momentum funds, you have mid-cap quality funds. So there's now about 10 to 12 different type of mid-cap passive funds that you choose from. So I do believe that yes, complexity has gone up, and I probably project this will go even more complex in the next 5 years. And the reason why the complexity increasing is because as an AMC, we have to cater to a lot of customers. We have customers who are institutions, who are family offices, who are distributors, advisors, retail investors, and there is demand coming from all sources. Also, as an AMC, also we have to be continuously ahead of the curve. We don't know which fund will scale up. To be honest, we don't really have a clue. The funds which have scaled up, we never thought it would scale up 5 years back. So I think you have this industry which is continuously trying to innovate, and which is why you see a lot of funds, unfortunately. But I do believe that that investors need not have to look at all the funds. 4 to 5, 6 mutual funds are more than enough. Don't be distracted by NFOs and by new products. AMCs will always come and market their products, but the idea behind this industry is to not really say yes to a lot of things. It's to say no to 95 things and say yes to 5 things. And I think the behavioral piece is somewhere where I believe the advisor can really help navigate the complexity and also manage behavior. So yes, and that is something which unfortunately as an AMC we don't really have a solution for. However, there's one thing that I think at least we are doing as an AMC. We have 40 passive funds. 40, which is a huge number, probably the highest in the industry. We launched about 35 in the last 4 years. But what we do is we don't talk about any of the 40 funds. We talk about 3 funds. So I think AMCs also need, obviously you have different funds for different type of people, but when you ask in public, we only talk about 3 to 4 funds that we are positive for wealth creation. Even in our meeting, if I meet hundreds of investors or if I meet a lot of clients, I talk about 3 to 4 funds max. Now, if they're looking for a specific fund, I can say that yes, we also have that if you're interested, but I don't talk about it. Okay. So I think one way in which you can reduce complexity is to really have 3 or 4 funds that you would recommend, put ahead, make sure the user experience is such that you had most investors invest in those funds, and obviously have other funds, but you may not want to highlight it as much. So that's what we're trying to do.
So what I can get is active fund managers are not dead. Okay, so definitely there are opportunities where through actively managed funds you can create a positive alpha. To the role of the advisor, I think it's to pick up the right advisors. So may construct a portfolio of actives and passives by picking up the right fund managers and picking up the right indices. That's what I could get from what you were just mentioning.
Absolutely.
And like I just mentioned, we have started this multi-index strategy where, like what Pratik mentioned, we're trying to simplify it by giving a portfolio of 5 indices actually, which will be based on factors, sectors, and basically on the market capitalization. And I think that this is a way forward, which definitely a lot of investors will start having allocation to passives going forward. In fact, coming to now, we have been talking about a lot about the Indian indices, okay, and I think that's where you're getting the maximum traction also. But people don't talk about too much of you have commodity indexes also like silver or gold or international indices actually. Is it because of lack of knowledge, or do you feel that investors should have a part of their allocation in these type of commodity or international index funds also?
I think if you look at global portfolios, if you look at portfolios of clients in say Southeast Asia or the US or Europe, most portfolios are pretty much multi-asset. So you will see a good part of the portfolio outside their home country. You'll see a good amount of the allocation towards say some sort of commodities, gold, silver, aluminium, whatever, and you have equity and debt. So I think Indian portfolios are also getting there. I think the biggest reason to why you should have gold and silver in a portfolio or to have international portfolio is not because of the growth aspects in these. In fact, Indian equities will most probably beat returns of gold and silver or international funds over the long run. The reason why you should have this is because it really reduces risk in our portfolio. A lot of people diversify by investing in multiple mutual funds, say a large cap fund, mid cap fund, small cap fund. The problem with that is that when the market falls, everything falls together. So when you're investing in Indian equities, your risk is not really diversified, regardless of how well you diversify across strategies. the only way to reduce risk in our portfolio is via diversification in asset allocation. So having some money in international, some in domestic, some in gold and silver, some in fixed income. If you add all of these things, what happens is when you add multiple assets in your portfolio, if one asset class does badly, you have the other three to save you. So Indian equities gone down last 3 months, but foreign equities is up, gold is up, silver is up, fixed income is doing well. So your portfolio will barely have a drawdown. Whereas if you have say 80% Indian equities, 20% debt, you would be down say 3, 4, 5% depending on your allocation. So I think multi-asset portfolio is a gold standard for asset allocation, and that's why we would recommend having a portfolio in multiple assets. Having said that, I think gold and silver is something which is not really been understood very well by the industry. I think gold and silver both are, well, at least gold is an unproductive asset class. And I think a lot of industry stalwarts have been against gold because it's a piece of rock. Why should you give value to a piece of rock? Just because it's scarce. There are a lot of other scarce rocks, but why give gold so much value? So that's the debate, and that's why I think a lot of investors don't dislike or like gold. Having said that, we like it because as I said, from a diversification perspective, it makes perfect sense in a portfolio. And also gold does well in a bear market, which very few asset classes do. So that is one. With internationals also, I think that is one asset class that people used to talk a lot about in 2020 to 23. But what has happened is RBI has closed the industry. So RBI has shut most mutual funds. And that's why, no one really talks about international funds, because if there's nothing to invest in, the only way the majority way of investing internationally is through LRS, which again is very expensive. So I think when limits are opened up, which I hope they do over this year or maybe next year, then you will see the conversation back towards international. That is one such asset class where I believe everyone should have an allocation, because we are consumers of American products more and more. I think this podcast will be on YouTube, which is owned by an American company. We use Netflix, Amazon, we buy watches, shoes. So I think your portfolio should be aligned to what you spend on.
True.
And I think more and more spending is towards these global companies. And I think they should be in your portfolio as well, especially with AI and all this coming in. So I think we are very bullish on internationals, especially the US markets. And I think investors should look at those markets for a small amount of allocation. Small number can be in gold and silver. And I think the main reason for this is purely diversification.
Wonderful. Actually, it's so true because last 3 months have been a challenge for the Indian markets.
Yeah.
But you have seen these asset classes which have done
very
quite well. So having a negative correlated portfolios, can help investors lose portfolios for less and create an alpha over a longer period of time. I'll just ask you bullet questions now, in fact.
Sure.
So one is on the 3 types of indices which are there. So your top picks in factor-based indices, which will be your top pick?
Momentum.
Even though in this kind of a market, you feel it's good?
Honestly, I'm a long-term point of a guy, so it doesn't really matter.
Wonderful. Market cap based?
Nifty 500.
Okay. And sector?
Sectors would be, I'm very bullish on...
sector, I think themes are also there.
Capital markets theme I really like. Because I'm biased. I'm biased right now because Motilal Oswal is also a capital market focused entity.
Right.
So we are very bullish on the stock market, on wealth creation. It's a very narrow industry, only small and mid cap stocks. So it's a good, we believe it's a very powerful thing.
Okay. So, and what do you feel? How much allocation should an investor have? And we're talking about an HNI or ultra HNI investor typically, who is already there in mutual funds, direct equities. Maybe he's not there in passives the way he should be. Okay. What is the percentage allocation you feel they should have in passives?
Yeah, I think minimum 25%, 25 to 30% is a good allocation.
Okay.
In passives.
And what's your outlook? This is one question which I won't let you go.
No, so very
with
positive.
The market's falling already.
Yeah.
So, what is your outlook about the way forward for Indian equities?
So, markets falling honestly is a good thing. We've had a crazy 4-year run where the markets have delivered 35-40% returns. And I think it's nice to have a breather. I think the reason also why we need a breather is because earnings need to catch up. What has happened in India is that, markets have now ahead of earnings. What does that mean? That means that India was very expensive as a market, and somewhere their justification was that our earnings are very strong. So, but what has happened the last quarter is earnings have slowed down. Consumption has slowed down. There is some slowdown happening, which is very visible in the Indian economy, and our markets are still expensive. So somewhere we need to make sure that for investors is that if we have say a year or maybe 6 months where markets are flat, where we give earnings time to catch up, that's great for everyone, and then we can continue on the bull run. So I think you cannot have a market growing at 30-40% and earnings growing at 15-20%. They have to be almost the same. Earnings have grown by some 15-20%. Markets have grown at 40%. So somewhere we need to have a 1 year like what we have in 21-22, where markets were flat, earnings caught up. So the best hope for us right now is to have maybe 6 to 8 months of flat performance, and then hopefully maybe by middle of next year we can start seeing a rally again. That's what I would hope for, but honestly, very hard to predict these things.
Absolutely,
I think definitely bull. It's not even close to the euphoric levels of any bull market. A bull market. We've had a bull market, but the top of a bull market tends to be a lot more euphoric, a lot more expensive, a lot more optimism. People have a lot of fear of missing out. That is something which is not happening right now. So it's definitely. People ask me, is this a peak of a bull market? It definitely doesn't have any of the characteristics of a peak of the bull market. But definitely markets are expensive, that is for sure. And, hopefully we've already had about 6 months of a flat market. Maybe another 6 months would be great, and then hopefully we'll have a bull run again. But long term, very optimistic, very positive. I think, the good thing about India in the last 5 years is India used to be a very narrow country where we had growth coming from consumer, financial services, healthcare, IT. But in the last 5 years, we've had broad-based growth. We've had companies that were dead for 15 years. Real estate, infrastructure, utilities, PSU companies, and finally after 10-15 years, there is greenfield projects where industrials are investing into land, infrastructure. So I think that's a very positive sign for long-term India. And I think because of this broad-based growth, I'm much more optimistic than I was, say, 5-10 years ago. So overall, I think very optimistic over the long term. The short term, would love to have a breather.
Okay, so you're expecting a time correction more than the price.
That would be the best, but hard to say what will happen. That would be the best. That would be the best, where we just have a flat market scenario for the next 6 to 8 months time, and then hopefully markets can start again.
So Pratik, it's wonderful as always to talk to you because I don't find too many fund managers talk about passives. Too many people who actually talk about passives, and you have been focused on this space, you and Motilal Oswal. Right from the day you created this separate division of having only a passive strategy, team, in fact. And as things progress, 3 years back were different times. Today, I think the acceptance level for passives is increasing. I'm sure advisors are also now started looking at this space to diversify a portfolio of an investor, in fact. So before we end, anything what you would advise our investors how to approach this space?
I would say two things. One is read a lot of books. I think not a lot of books, but at least 4 to 5 books on investing. I think only advantage that as industry people we have is the knowledge we have. And I'll be honest that knowledge is not very complicated knowledge. It's simple stuff, and that we've seen over the last maybe 10-15 years time. So I would say that take investing very seriously because it's your wealth that you create from investing is hopefully going to be far bigger than what you could do on your job. For most people, if you look at every wealthy person on the planet, most 99.9%, they create wealth not from their jobs. They create wealth because they own something. They own their own business, they own equities, they own gold, real estate, whatever it is. So I think ownership is very important to create wealth. And I think the sooner you understand ownership, the easier it is for you to create wealth and financial freedom. So I think financial freedom comes from ownership. Obviously, equity gives the highest returns, but other asset classes also there. So I think take it seriously, read a lot of books. It's going to have a much bigger impact on your future life than maybe even your job. So, and I do think that reading books can really help you become very good at it.
Mm-hmm. Wonderful. In fact, just before we end, today I was just reading one post which came on LinkedIn, and it was saying it was about Warren Buffett, and he said that the poor spend all the money. Okay, the middle class actually they save all the money, and the rich are the ones who actually invest all the money
Yeah.
actually into equities. And I think it's so important after seeing a great rally, and we are in a country like India, that definitely over a longer period of time you will end up making great returns actually. Thank you very much.
Thanks,
Thanks.
Nilesh. Thanks for having me.